everyone. So thank you very much for tuning in. Today is Wednesday noon and we are bringing you the Real Talk with JT. I have a very special guest over here today. The numbers guy. The guy who knows the stuff to make the deal happen. We call him the artist when it comes to mortgages, because he always finds a solution when there is no solution.
Well, I appreciate that.
The one and only.
I don't know that the government would like
direct.
Okay, hi everybody.
Peter, thank you very much for coming. I really appreciate that.
I just have to say, I don't always find a solution.
99.99999%.
Thank you.
Yes,
sir. I appreciate that.
So Peter, I first wanted to introduce you, of course, so tell us, how did you get into mortgages? What's your background?
My background, I actually have an interesting. I think it's an interesting background. I have a degree in undergraduate business degree in computer information systems and marketing. And then when I got out of school, I actually got into real estate. When I got out of college, I started working for a real estate developer in New York City, in Manhattan.
That's interesting.
Very interesting.
Okay.
And he put up a number of high-rise buildings in Manhattan.
Nice.
So I was sort of learning from a project management standpoint how to put up buildings.
Wow.
And then I went from real estate development to real estate management, always using my computer skills and my computer background.
So very savvy, very good with the computer.
Oh yeah, I used to be a software developer and a DBA, a database administrator. I've helped create a number of different softwares. I worked on Wall Street. I had worked for investment banks such as Goldman Sachs and Merrill Lynch, doing database development, software work, both in New York and in London. So that was really exciting stuff. And then I also had a little bit of an acting career. I actually I moved out to Los Angeles. It was actually right around when September 11th happened. I was downtown by the World Trade Center, and I thought to myself, you know what? I want to go for my dream, and my dream at that point was becoming a professional actor, and so I went to Los Angeles and did a little acting. So
how did you get into mortgages after acting?
So after acting, and I realized that I was a good actor, but just wasn't going to pay the bills and wasn't going to keep me alive. I decided, I came back from Los Angeles, back to New York, which is where I'm from, and from Queens, and I said, let me get back into the financial industry. And I did a few things before mortgages, but then someone that I had met during my time back in New York said, you really should try mortgages. You're good with numbers, you're good with people. I think you'd really like mortgages.
Well, I can tell you, thanks God to the God of real estate that you come into mortgages. Okay.
What a guy.
Well, if of course, with your permission, if I may, we have some questions over here for you.
Of course.
When it comes to mortgages, and some of the big ones actually. The first question we have is, what's really the difference between a mortgage broker and a mortgage banker? Small guy versus a big guy.
I don't want to say small versus big.
Okay.
Because it doesn't necessarily mean that a broker is the small guy. A broker, as in brokering a deal, right? What's a broker? A broker connects two people, right? Real estate broker, mortgage broker. So what the mortgage broker does not actually. Mortgage broker connects the client to the bank, right? Connects the client to the bank.
Middleman.
A mortgage broker, as sort of, I think if we would look up the word broker, probably yes, there's a middleman, there's the middleman concept, right? So what's the theory? Why would someone go to a broker? Someone will go to a broker because someone referred them, and frequently a lot of business, as you guys do in your life, no doubt, we do referral business, right? We go to people who people feel comfortable with and have
correct.
used, and they say, hey, you got to try that person.
It's a word of mouth, basically.
Word of mouth. I mean, it's actually 99% of how I get my business is word of mouth business. So a broker. So you sit down with a broker. A broker doesn't actually originate. Well, they originate the loan, but they don't work for a bank, right? They don't work for a bank. They work with banks and a number of banks. So you go to a broker with your particular scenario, and the broker, through his hopefully vast relationships, his or her vast relationships with banks, they take your scenario and your scenario, and they figure out which bank that they're connected to will give you the best option for your scenario. That's basically how it works. And they take a fee for that. Usually that fee is somewhere about 1% of the loan amount. It's usually about 1% of the loan amount. And that's it. They collect your paperwork and they speak with their contact at the bank. Normally they have better interest rates than you'll find at walking into a branch, right? That's why you go to a broker, because a broker is working with a lot of different banks and has wholesale pricing.
Now my question is, and I think this is actually a probably very common question for the buyers. Okay, if I go to a broker, right, and let's say he will broker out a deal to another bank, is it more expensive for the buyer to go through the broker rather than going to the bank directly?
Yes and no. It can be more expensive,
Okay.
And then again, possibly not. It depends on, it depends on what the broker's charging. It depends on, and the broker can charge whatever they want to charge. I mean, there may be a cap on that. Actually, I'm not sure, but again, normally I say it's 1% of the loan amount, but it's not necessarily they're gonna pay. They're gonna pay. I mean, it's the broker's job to take a fee, and then get you the best deal that works for your scenario as possible, right? And the only thing is okay. So those are the pros. Should I tell you some of the things? So some of the things that you don't have with a broker. The broker has less control of the deal, right? Because the broker is not working at the bank. Versus a banker like myself that's at the bank. Right?
Also, you mean, so let's say if once the deal goes in and it goes to the processor and underwriter and stuff like that, they don't really have the ability actually to see exactly what's going on and sort of speed up the process. Right?
Normally not.
Okay.
Now there may be some brokers, and I'm sure there are some brokers that have been around for a while, or some brokers that have that kind of contact, but
Connections. Relationships.
There's a chain of command, right? As in any job or life, right? You've got a chain of command. So it would sort of be out of the norm for a broker to break the chain of command from his contact at the bank to go to a processor or an underwriter, right? That's unusual. Does it happen? I'm sure it probably does, but it's unusual. So versus a banker like myself, that in my office, actually, in my office, and I work out of a Great Neck, Long Island, New York. In my office, we actually have an underwriter and a processor, two processors in our office. So, I have one of the benefits of working with someone like myself or a banker or some bankers, because a lot of banks don't have processors and underwriters in their office.
Right, have it like outside,
right,
in
like
the headquarters or something like that.
Exactly. I mean, if you walk into a Chase bank or a major commercial bank, and by the way, there are three different loan origination entities, right? You have a broker, which we've spoken about. We have a banker, like myself, that sits in a mortgage bank, and that's all we do is mortgages. And then you have a commercial lender. Commercial lenders such as Chase, Santander,
so
TD
they
Bank.
do also like a checking account,
Exactly.
investment accounts. So this is like just one of the products.
Exactly. In fact, those banks, we call them commercial banks. We call them depositories. Why you call it a depository? Because you deposit your money there. And one of the things, as John just said, that they do is they give their clients mortgages. They don't specialize in mortgages, right? So here's sort of like I don't want to say a downside, but when you go to a big commercial bank, and most people do because they have familiarity, right?
No, let's say if you have a good relationship.
You have a good relationship,
Have,
your existing bank accounts are there, you have a familiarity, you feel comfortable, they have the reputation. But at your branch, sometimes you don't even have a mortgage person at the branch.
So if
right?
you need to get a question or you need
exactly
to get somebody to get on the phone, I mean.
Well, you sort of have to,
okay.
And then sometimes you have mortgage folks, mortgage loan originators that visit branches on specific days of a commercial bank, right? Because there's not enough business to keep that person busy. And so what that person does at the branch, you don't have underwriters, you won't have an underwriter that I'm aware of, none that I'm aware of. Do you have an underwriter or even a processor at a branch? Normally, they're at some location, where they're all together somewhere in the United States, and that's where they're processing or underwriting your loan. So the underwriter the loan originator and that's what they call us, by the way. We're loan originators, right? So we originate loans.
So you're sort of like the guys on the front line.
Correct. We're the guys on the front line that deal with the clients. So a mortgage broker is also known as an originator. Actually, 10% of the business that comes in to loan origination to the banking world is done, I read this recently, is actually done by brokers. About 10% of the business.
10% of the business.
10%
Wow.
of the mortgage banking business.
So the other 90% is done by the bankers.
It's done by a loan originator connected to a mortgage bank or a depository or commercial bank. So someone at a commercial branch, you bring them your documents. They tell you what you need, and then they submit. To their processing department. Their processing department processes it, puts it together, and then ships it out to the underwriting department. Okay. So that's normally the flow, right? You get the documentation from the client, then you have to get disclosures signed, right? The client has to give you disclosures.
That's the loan processor job, or is the originator job to get the disclosure signed?
It depends. That's a good question. It depends on the way that the bank is set up.
Okay.
Frequently, much of the time, it is the job of a processor or a loan. We call them a loan opener. Loan opener opens the loan and then gets disclosures done and then gets it out to the client and back. But in smaller banks, the loan officer, the loan originator, will have. Sometimes they even open up. I've been in a bank. Actually, I started where I was I think I opened my own files. No, the opener did the disclosures, and then it was my job, and I think the opener is one of us to get it out to the client.
Sort of, you were like working together, hand in hand.
Yes. Yes.
So if I just can go back to the brokers, right? The mortgage brokers. So does
By
every
the way,
broker?
you got to keep me on track. So
I know.
I can,
You can go on and on. I mean,
so
it's
keep
all good stuff.
Keep me on track, brother.
I mean, but you always give a good stuff, so I don't mind it.
He's very complimentary. If you can get on his show,
yeah.
Anyway.
Hi Cheryl, how you doing? We got some people watching actually. We got Carlos and Cheryl. I want to give them a big shout out.
Cheryl.
It's a good friend of mine and associates from Dallas. So thank you very much for joining in.
Thank you for joining us.
So I mean, back to the broker. Does every broker has an access to the same banks? Like, do they have the same portfolio? If I go to broker A or broker B?
Absolutely not. No. Brokers. It's the relationships that you forge with different lenders.
So the better the broker is, the more relationship he has.
Absolutely. Well, see, it's interesting because some brokers, I think, just want to specialize in some maybe niche of the market. So they don't, you may say, well, it's better to go to a broker that has various relationships.
That's right. Yeah.
But then again, there are some people, just like in real estate, right? Some people want to focus in residential, some people want to focus in commercial, some people want to focus in a certain area of New York or a certain area of wherever you live, certain towns, and so it's your different niche market that you have an expertise in. That people say, this guy, if I have low income, for instance. There's a lot of clients that come my way who are self-employed and have low income, right? So if you're a low income person, you know that this broker knows how he's connected to the banks that get low income loans done. So yes and no. So it's not necessary that they have vast relationships, but they know how to get things done within the relationships that they have in the scenario that they have.
So what do you think it will be the pain points, let's say, going with a bank and going with a broker?
I'm sorry, the what?
The pain points, like pluses, minuses. What do you think it could be the setbacks actually going with a bank, a direct lender?
Setback going with a direct lender. I would say if your scenario is a complex, potentially difficult scenario, it's probably better to go with someone who is I guess, I don't want to say, it's someone with experience, is really what I want to say, right? Because you don't want to take a complex scenario and give it to someone who's newer in the business and or sometimes can't, get it through. For instance, let me say, at my bank, we are able to do title exceptions. Okay, so if there's an issue on a title report, we can get an exception by the bank, by the underwriter, the head underwriter, to approve the title. So it really depends on the complexity of the scenario and what comes up.
Okay.
My feeling is, and one of the reasons why I am where I am and why I do what I do, is because I feel that at a small to mid-sized company, there's more
better grip.
You have more control, and you have more avenues. It's less conservative. If you're what we call a paper would be someone with amazing credit, have enough money in the bank for closing costs and down payment. You have no issues with your job history. You get a perfect scenario. If you have a perfect scenario, then you call the shots, right? You call the shots. You can walk into any bank
and try to negotiate.
You could almost dictate your own deal, right? Versus the guy who, he was in a job for 6 months and then he got out of that job and he went into another job, same industry, different job, and then had sick leave and different.
So it will narrow down the options for him.
It could make the loan a little more complex, right?
Okay.
Or I'm doing a scenario right now where the house is a 2-family home, a legal 2-family, but it's being what we call underutilized. So it's set up as a 1-family. So do you do the loan as a 2-family or you do the loan as a 1-family? Well, it's in the borrower's best interest to do it as a 1-family. As a 1-family.
Okay.
Why is it better to do it as a 1-family? Because he's going to get a better interest rate. That's why. That's pretty much.
But let's say the other scenario, if maybe the purchaser would have that good income, and you would qualify him as a 2-family, then he can take the income from the second unit, sort of.
Correct. But in this scenario, it's such an interesting scenario because when the appraiser goes into the home to appraise the home, and he sees that the home is set up as a 1-family, you're not getting the rental income on the second unit.
I gotcha. Okay.
You won't get it, even though it's a 2-family. So I would feel bad. And then there's also reserve requirements that you need for a multifamily home versus a 1-family refinance. You need to have reserves.
Show money in the bank account.
You have to show money in the bank.
Oh wow.
Right. So there's so many different nuances and things are changing, and it's much more difficult today, as many of you may have experienced. It's much more difficult today to get a loan than it was prior 2008.
Hey Francine, thank you for joining in. We got Francine from Freeport.
Wow, you can see that. Hi, Francine.
Yeah, I can. It's kind of small, but
It's very small.
I can read what's underneath what they're actually saying, but I can see the name. Yeah, that's Francine. Yeah. So I mean, so I see there's some pluses
Yeah.
to go with a banker and
Yeah.
go with a broker, and there are some minuses too.
Absolutely.
Okay.
I don't. I think the bottom line
Is there like a combination, broker, banker, like a hybrid? Can you be a banker and can you be a broker at the same time? Let's say
No.
you can do the loan.
No, that's a good question. Let me just say one thing before I answer that question. If someone were to say to me, "Hey, is it better to go with a broker or a bank or a commercial bank?" I wouldn't give you an immediate answer. I would have to say, "Well, let me find out what your scenario is. Tell me what your scenario is, and then I'll tell you where I think would be best place for you to position yourself." Now, to answer your question.
Okay.
Oh my God! Repeat the question.
So is there?
Sorry.
So
Short-term memory.
So is there a hybrid, basically combination between
Yes,
a
I got
banker and a broker?
Okay, so if you are a mortgage loan originator working for a bank, you cannot, to my knowledge, and I'm 99% sure I'm right about this. I'm 100% right about this. You cannot be a broker. If you're a banker working for one bank, you can't broker to other banks.
It would be like a conflict of interest.
It's a conflict of interest. It's a conflict. I'm not. What's the logic behind that? I don't know the logic why. But it's a conflict of interest, right? If you have someone working for your office, working for you as a realtor, you don't want them working. Right? It's the same thing.
For the competitor.
It's the same thing.
Yeah.
If someone's registered for you under your brokerage, under the Tayeb Group brokerage, they can't be selling real estate. It's the same thing.
Okay.
It's the same thing.
Well, if you guys can hear us correctly, or if you find this info to be informative, just give us some hearts, give us some likes, let us know this is valuable. The second question I have, it's fixed rate versus an adjustable rate.
Mm-hmm.
Can you go a little bit more deeper into it?
Sure.
What's the difference between those two?
Sure. So, fixed rate, right, is that you have a fixed rate mortgage for a certain time period. 15 years, 20 years, 30 years, whatever it's normally
100 years?
30.
100 years no more?
No. I believe 30 is the max. In fact,
It used to be 40 years. It used to be 40 years actually.
Yeah.
5 years back.
So fixed rate mortgage, you're fixed for a certain period of time. Adjustable rate, the rate adjusts. It adjusts after a fixed period, right? So you may have heard, or if you haven't, it's out there, 5-1 ARM, 7-1 ARM, 10-1 ARM, 15-1 ARM. 15-1, 5-1 means that first number is telling you how many years the loan is fixed for.
Okay, so it's a 5-1, so it's fixed for
It's
5
fixed for
years.
5.
Okay.
And the second number is how the loan will adjust after that first number's years, right? So it's a 5-1 ARM, means you're fixed for 5 years, and in your beginning of your 6th year, your loan adjusts based on usually what's called an index and a margin.
Okay.
Okay. And then it adjusts every year thereafter. So the adjustment period.
So the one means that every
So the one
year.
means every year there's an adjustment after the 5th year.
Okay.
7-1 ARM, 10-1 ARM, same thing follows. So, and that adjustment is based again on an index and a margin. The margin is a set number. I think normally these days it's somewhere around 2.75%. 2.75% plus an index. And that index is usually something from the United States government, or U.S. Treasury. The U.S. Treasury 1 year, 5 year, or LIBOR. Sometimes loans take on the London interchange banking. I don't know the LIBOR. So they take the margin and the index. They add those two together, and that becomes your new rate for that 6th year, and then again the 7th year, and so on.
Do they have, let's say, 5-2 or 5-3 ARM, or 5-5 ARM? 15-2
Yes,
ARM?
they do
ones?
actually. Yeah, they do. I'm not really familiar with those because I've never. I've read about it.
It's very rare for the buyer to get the ARM loan, right?
Well, let me tell you
Usually
something.
most loans are fixed, I believe, right?
You know,
My
this
experience.
is a really interesting topic, and I could. let's talk.
We got 5 minutes
Let's
left, so
talk
we can
about
maybe
this.
touch base on it a little
Yeah.
bit, and we can discuss it next time.
It's really, you use an arm, and I say you use it because you want to use an arm when it works, obviously, to your benefit, right? So a lot of people think, 30-year fix. I want to have a 30-year fix because I know my rate, my rate's not going to change for 30
It's
years.
guaranteed for 30 years.
But
right?
here's the thing. You know that most people, I think it's 7 to 10 years is the average.
That's right.
That most people,
they'll resell.
they either resell or refinance. So you're either going to take money out, cash out refi, because you need the money maybe for another investment or something like that, or you're going to sell your property. 7 to 10 years, that's the average.
That's a great
Verified
point.
by John Tayeb.
That's a great point you're making.
So if you think about it, that's the average, and you want to play your odds, and you say, well, let me take advantage. What's the advantage of an ARM? Well, you're going to get a much better interest rate. Much better interest rate. Normally. I take that back. I don't say normally an ARM, because it's more risky, right? You don't have it fixed for 30 years. You're getting a better interest rate. So, and it doesn't necessarily mean that when the fixed period of the ARM is up, that your rate's going to go through the roof. First of all, it can't. There's caps.
Or maybe the rate's going to go down.
Maybe exactly, because you don't know where that index is going. Right? You have to look at the particular index and see the history of the index. The U.S.
in the
Treasury.
90s, the rate was like 12 or 14%. In the 80s, it was like 14%.
Correct.
Now
Correct.
it's
Correct.
5,
You
4,
just
5%.
don't know where it's going to be.
Yeah, exactly.
And you can always refinance before it adjusts or after it adjusts. I mean, if you're in a position to refinance, you can always do that.
Let's say if you have the fixed rate, you can refinance that as well, right?
Yes.
Locked
Yeah,
in
no.
for 30
You
years.
Most. I don't know if it's all loans, to be honest, but most of the loans, residential loans these days, have no prepayment penalty, and you can refinance out of it at pretty much any time.
I mean, the only setback would be you have to pay a closing cost.
You have to pay new closing costs. Yeah, you have to pay new closing costs.
But it's not like as on a purchase, right? Because on a purchase you pay
That's correct.
4 to 6% of the loan amount.
That's something like that.
So on the
That's
refi
correct.
it would be probably a lot less.
That
right?
is correct.
Some of
That
the
is
costs.
correct. And if you're in New York, we have something called the SEMA. The SEMA is not accepted by every bank, but it's an assignment of mortgage. It's an assignment of mortgage, and you can save money on your mortgage tax. Mortgage tax is like paying sales tax on buying an item in the store.
Oh yeah, that's a big one.
That's a big plus.
Yeah.
So people, you don't get hit for the same tax. You get hit for the difference of what you made the purchase to the new loan
You're getting
amount.
more money. Obviously, your loan amount is bigger. You pay on the difference.
Correct.
Differences.
Correct.
I mean, with that said, the refi. Do people usually refi to lower the rate or get money out,
Both.
or both ways?
Absolutely.
Okay.
Absolutely.
So I mean, if you refinance the house,
Or to
you
get
say-
somebody off, or get somebody off the loan.
Okay.
Yeah.
So I mean, if your loan amount it's certain and you just want to lower the rate or take somebody out of the mortgage loan, you can keep the loan amount the same. You don't have to take money out of the house if you don't want to. Because
Correct.
some people don't want to do that.
Correct.
Right?
We call that a rate. The two types of refinances are a rate term refinance, which is just taking somebody off the loan and or hopefully getting a better interest rate. Or in the case of FHA, I have a lot of clients that come to me that use an FHA loan to get into a house, but with the FHA loan, you have this monthly mortgage insurance that stays for the life of the loan, the PMI. So how do you get rid of that? You refinance into a conventional loan.
It used to be only for 10 years. They changed recently, I think.
Right. So a few years ago, I think it was sometime in late 2013, I believe. FHA, I think they were just so you know, our time is running down.
About a minute.
Okay. But the FHA said, you know what? We're going to now make the mortgage insurance premium stay for the life of the loan. Unless, there is a stipulation, there is an unless you put 10% down payment on an FHA loan, you can get out of the FHA mortgage insurance after, I think it's the 11th year. I'm pretty sure it's the 11th year. Yeah.
Well, very informative. It's always a pleasure having
Thanks,
you.
sir. Appreciate
If
that.
you guys have any more questions, my information should be right below. Peter's information is right below. It's 12:30 sharp, so we're gonna be ending. The alarm just went on.
Sir, thank you. Thank you,
you guys
everybody.
for tuning in. Okay.
Take care.
Have a
Appreciate
good
it.
one. Bye bye.